Hello everyone. Welcome to today's Practitioners Insight webinar, Integrating Sustainability in Investment Decisions, What, Why, and How, hosted by CFA Institute. First and foremost, a very warm welcome to all our audience joining us for this very important session from across the world. I am Pankaj Sharma from CFA Institute, and I will be the moderator for this session. I lead capital market policy for CFA Institute India, and in my role, I am responsible for advocating policy positions on a broad range of issues which relates to stakeholders. Before I introduce our speaker for today, I have a couple of housekeeping points. Today's webinar is for 60 minutes, first around 40-45 minutes for the presentation by our speaker, and then 15-20 minutes for the Q&A. But rest assured, we'll be leaving ample time for question and answer. Please feel free to submit your questions throughout the presentation whenever you want. You can do so by clicking on the Q&A icon at the bottom of your viewer and typing your question in the box. We immensely value your feedback, so please complete the evaluation survey before you sign off today. Now it's my pleasure to introduce our speaker for today, Mr. Hardik Shah, CFA. Hardik is a sustainability-focused leader with over 16 years of experience spread across ESG research and investing, climate change, and carbon credit advisory, business intelligence domains. Hardik is currently focused on strengthening DSP mutual fund ESG and sustainable investment efforts and collaborates with the investment teams to provide integrated solutions to clients in India and globally. It's a very interesting role. We ourselves learn a lot from him. So I hope that this session will be very useful for you. During his time at GMO, Shah was responsible for building its global ESG capability across investment product areas and asset classes. His efforts included creating GMO's proprietary country ESG model, as well as the company-level GMO ESG score, helping various investment teams with their ESG integration and engagement efforts. And he also designed fund-level ESG reports for GMO strategies. Before GMO and before joining DSP, he has worked with Sustainalytics, MSCI, and also EY. An engineering graduate, Hardik also holds a postgraduate diploma in management and finance, the fundamentals of sustainability accounting FSA credential issued by Sustainability Accounting Standard Board or SASB, the Sustainability and Climate Risk SCR credential by the Global Association of Risk Professionals. And last but not the least, or I would say equally very important, he is a CFA charter holder. A very warm welcome, Hardik, and it's a pleasure to have you with us today. I'm sure that our audience is eagerly looking forward and will have a great experience listening to you. So without further ado, over to you.
Thank you, Pankaj, and thanks to the CFA Institute for inviting me to share my thoughts and opinions today. Hello, everyone. For today's discussion, the topic we have at hand is integrating ESG and sustainability or ESG into your investment decisions. Before we get into the presentation itself, I think it would be worthwhile noting that while I've used some of the illustrations from the way we kind of integrate sustainability here at DSP, broadly, the comments that I'm going to make here are my personal and should not be ascribed to my firm as such. With that let's kind of jump in, right? So when we think about integrating sustainability or ESG into investment decisions, everybody seems to have their own view of what is right, what is wrong, what should be allowed, what shouldn't be allowed. And I think at sometimes you'll find people still saying, is it even useful, right? Is it even necessary to do that, or should we just focus on financial returns? And all of these are valid questions, in my opinion. During today's discussion, I think my goal is to essentially get you through three main kind of buckets, right? So what exactly do you mean by ESG, responsible investment, sustainable investment? You might have heard a lot of these words at different points in time. Are they all the same? Are they different? Once we establish the definitions, we go into why exactly should investors be concerned about these issues, right? Isn't our job to just focus on returns for our clients and manage risk? So we'll kind of go through that, why exactly I feel, and why exactly a lot of investors across the globe are paying more and more attention to sustainability issues, both risks and opportunities. And then the more important question is, once you're convinced this makes sense to do, how exactly do you do? And therein I have put in a case study as well. So I think I'm hoping that during the course of this webinar, which is about, I think I'm going to present for about 35, 40 minutes, I'm able to kind of answer some of these questions. But like Pankaj said, in case you have further questions that you'd like me to address, we'll have at least 15 minutes, if not more, towards the end of this webinar to address your questions. So feel free to punch them in as and when I'm kind of moving along. So with that, let's jump into the discussion. A quick brief about DSP for those of you who don't know us. The DSP Group has a long and a storied history. We've been involved in the Indian financial markets for more than 150 years. DSP family itself is one of the founding members of the Bombay Stock Exchange. So this history goes back quite long. As an asset management firm, the DSP Asset Managers, the firm that I'm representing and I work at, we are primarily focused on investment management. So essentially managing money for both retail and institutional clients, investing them in the right companies and strategies to basically get the best risk-adjusted returns for them based on their kind of risk appetite as well. If you look at the types of asset classes we are currently having exposure to, so about out of about 25 billion US dollars roughly in AUM, about 20 of them are in equities. So about 75-80% of our assets are in equities. We do also have fixed income and commodities exposure, but predominantly a lot of the stuff that I'm going to talk about today will be more equity focused. So just keep that in mind. Um, with that, let's jump into the first part about right? What exactly do you mean by sustainability, ESG, responsible investment, and so on? So let's kind of look at it from a definitions perspective, right? Um, UNPRI, or the Principles for Responsible Investment, which is the global body for investors who are kind of practicing sustainable or responsible investment, they define responsible investment as an approach that aims to incorporate material, environmental, social, and governance factors into investment decisions. And what is the purpose of doing that? The purpose is to better manage risk and generate sustainable long-term returns. So if you read this and understand this definition well, one thing is very clear, that the goal of responsible investment, or sometimes it's also called ESG investing, is not necessarily misaligned with the role of investing. When you are investing, you are essentially saying, I'll generate the best risk-adjusted returns, and essentially that's what um, responsible investment is also uh, aiming to do. Now, how is this different from what you see below in the Venn diagram, the SRI? So on the left, SRI is essentially socially responsible investing. So this is how it started maybe 20, 25, 30 years back now in the West, where certain wealthy investors were saying, we want our investments to have some sort of a positive impact to the society. And hence the whole kind of socially responsible investing kind of domain started, where they would say, either based on faith or religion or some other values, you don't want exposure to certain type of businesses. So this could be tobacco and alcohol. This could be some other sectors which are, let's say, not considered of right from based on your religion or values, and you would avoid kind of investing in companies like that. This versus RI that we just looked at the definition, the responsible investment, how is it different? Is because here what we are saying, we are not excluding any particular sector. What we are saying is, let us quantify more financially what kind of risks certain environmental or social or governance factors could have on valuations of companies in our portfolio. And after adjusting those risks, how do we kind of build a more resilient portfolio? So that's the key difference. And I think it's important to kind of understand that upfront. Now, the other kind of common challenge or myth when we talk about ESG investing is, everybody thinks there's only one right way to do it. And the answer is actually no. What you see on your screen are broadly accepted, let's say, 6 different ways of incorporating ESG factors, and none of these are like best to worst, or none of these are right or wrong. I think a lot of what you want to do will depend on what your clients' goals are, right? So, for example, what you see on the right hand side of the screen are basically different types of screening approaches towards incorporating ESG factors or sustainability factors. And so if your client, like the example we saw on SRI, if your client is saying, I want to exclude, I don't want to anything to do with gambling or tobacco or any sort of sin sectors, then negative screening is probably the right approach that you would apply to their portfolios, meaning you'll have a list of companies which are not allowed or barred from investment, irrespective of how good or bad they are from a financial perspective, because the client doesn't want anything to do with them. So that's one approach. On the other side, there is positive screening, which means you will choose best in class companies. Either it is based on some sort of an ESG score or a factor. It could be carbon emissions. There could be different metrics that you could use, but basically saying, I'll pick the best performing companies in every sector and build a portfolio on that. Similarly, norms-based screening is essentially excluding companies that are in gross violation of international norms. So the very popular kind of international norm that a lot of investors, both in India but also globally, screen on is the UN Global Compact principles. So these are like a set of 10 principles spread across environmental sustainability, bribery and corruption, social stewardship, and so on. And any company that is in gross violation of those will actually be excluded by most investors who are considering sustainable and responsible investing. So there are like approaches of screening that you see that's available. On the left hand side, what you see is active ownership. Now, active ownership is not something new, right? You will see historically, as an active investor, as a shareholder in equities, you would want to have a say in how the management is kind of running the business. You influence them to go in the right direction, again, with the end goal of managing risk and getting the best possible growth and sustainable growth, not just one off as such, right? So in the ESG terms, basically both in corporate engagement but also proxy voting, these are some of the ways in which you could kind of be an active owner of the business and kind of nudge them towards doing good and doing well. Thematic investing is something that is picking up more and more in the recent years, where you see themes like renewable energy, affordable housing, climate adaptation, kind of building portfolio of companies addressing that particular theme, because there is an investor, there is a set of investors who are willing to kind of allocate more capital towards these. Last but certainly not the least, ESG integration is actually the most popular approach towards ESG. And this is exactly what we saw on the previous slide, where what you are essentially doing is identifying material, environmental, social, and governance issues that could have a financial impact on the company's kind of valuation, and hence factoring those in while making your uh, discounted cash flow models, while making your expected return assumptions, and not kind of doing it in isolation of that. So that's broadly how like most of the kind of ESG integration or ESG incorporation approaches are here. Again, I'll try to re-emphasize, none of these are like too good or too bad. Depending on the client's need and goals, you could choose one or more, a combination of more than one of these to kind of build your portfolios. Um, Now that we've kind of understood the what, right, what exactly it is, let's get into, I mean, the natural next question that could come into some of your minds is like, why should investors care, right? Why should it be a concern to me? And this section is, I think, in my opinion, quite important. So let's kind of dig into it. The first point as to why should investors care is ESG issues are becoming more and more material. When I say more and more material, what is essentially I'm meaning is, if a company is mismanaging some of these risks, it is very likely that they will have some sort of material financial impact on their business. It could be in terms of let's say loss of sales. It could be in terms of maybe fines and penalties, which will obviously impact margins. It could also be in terms of just reputational risks. So there are different ways in which different ESG issues could play out, but the fact that they are becoming more and more material means that as a fiduciary, as a prudent investor, you should be paying attention to these things. And again, if you at the end of it determine that maybe this is immaterial, so be it, but you can't be ignorant. What you see on the slide is a couple of examples of how both macro or country level ESG factors, but also bottom up and company specific ESG factors could impact valuations. So let's take one example, things like environmental vulnerability, right? So you've seen even in the recent years in India, a lot of erratic weather patterns, whether it's floods, droughts, cloud bursts. A lot of these things are becoming more and more frequent, as well as more and more severe. Obviously, not everything is driven by climate change, but climate change definitely increases the both frequency and intensity of such environmental disasters. And obviously, it's happening at a country level or a region level, but that has the ability to kind of eventually impact companies in your portfolio via one of these three levels, right? It's either through the banking system, the cost of capital goes up. Sometimes you have uninsured assets that could get impacted, and so on and so forth. Similarly, at a company level, mismanagement of issues like, let's say, carbon emissions or not having circularity in your operations, so not reusing materials and basically having a higher cost of raw materials. These kind of factors obviously will impact one or more of the financial metrics, and hence eventually make you less competitive or maybe less valuable as a business. So this is kind of one of the key reasons why you see more and more investors paying attention to ESG factors. Let's take climate change as an example and dig deeper into this particular thing, right? So when we talked about materiality, so I'd like to kind of like you to focus on the middle and the right boxes here. I mean, on the left is essentially a formula for expected returns, but what you basically see here is examples of how certain macro climate related factors could impact the economy broadly, right? So in a lot of this, I've tried to keep it India specific, so it's relevant. For example, you've seen historically the groundwater levels kind of deplete across the country. There are very frequent water shortages, and this will become more and more severe as time progresses, because we both have a growing population, and obviously we want to support that, but also we have historically not used water as efficiently as we should have. So hence what is happening is there is water shortages both at the industrial level, but also at for agriculture. And if you see, like, why would this matter for India? Today, nearly half of India's inflation basket is basically food and beverages, right? So if you have water shortages, if there is either lack of production or loss of production, you'll clearly see an impact flow into inflation. Water resources per capita is currently expected to drop by almost 8 to 9% in the next decade or so, less than a decade now. Similarly, if you talk about rising temperatures, now you and I are both seeing that every year on year, you're seeing much more warmer summers, much more erratic weather. So what happens because of rising temperatures? It has straight a direct impact and inverse impact on labor productivity. So if it's going to be much more hotter, how do you expect the construction worker to kind of spend maybe 6 8 hours in the sun? It's physically not possible without kind of having some sort of health effects. How do you expect the farmer to go on the field for longer duration to be able to grow crops? Uh, that's the human impact. And also obviously because of rising temperatures, the crop yields might also go down because of just unfavorable weather patterns. So all of these things will have an impact on a country, as well as obviously eventually companies that you own in your portfolios. Similarly, I think one other point I would like to highlight on this is the last one on the bottom right, where uh, some of the studies are showing that because of climate change, at least 50 million people within India will actually have to relocate, meaning wherever you are staying today, it just is too hot or just too, I would say, too extreme weather to stay there. You would want to move. It's within the country. We're not talking about going overseas. We're talking about within India. You will see quite a significant migration of people just because of climate change. So these are obviously activities, initiatives, processes that will inflect the way your businesses and companies make money and sustain that profitability. And hence, as an investor, you should be paying attention to these. On the next 2 3 slides, I have some statistics, and I'll run through them more quickly in the interest of time. But again, if you have follow-up questions, let me know later on. We don't have enough carbon budget left to kind of limit global warming. So what is carbon emissions, right? So just maybe a quick 101 on that. The Earth atmosphere is covered with variety of gases. The reason why Earth is habitable is because of the layer of greenhouse gases, or predominantly carbon emissions and other gases like methane, etc., which are actually preventing the sun rays to kind of go back into space. So sunlight is hitting Earth, is reflected back from the surface, and because of this layer, which prevents the sun rays from dissipating, you are having, say, a livable temperatures, and hence Earth is an habitable planet. Now, because of increase of concentration of these carbon or greenhouse gas emissions, what has happened is more and more heat is trapped, and hence the world is becoming warmer and warmer. So in order to reduce global warming, you have to limit the amount of carbon emissions or greenhouse gas emissions in the atmosphere. What we are seeing clearly now, since the last about 6 decades or so, fossil fuel driven carbon emissions are clearly on the rise, and there is no evidence that this is stopping. What you see on the bottom left is a tracker by, I think, MSCI, which tracks how many months do we have left to limit global warming to a particular kind of range, right? So the Paris Climate Agreement, which was signed back in 2015, basically said as a world, we have to try and limit global warming to below 2 degrees Celsius, and preferably at 1.5 degrees Celsius. Based on current most recent data, we have less than 2.5 years to actually prevent the 1.5 degree Celsius temperature rise. And I think in most likelihood, we will cross that. When you say limiting global warming below 2 degrees Celsius, we have basically less than 20 years to do that. So it's not something that you have to wait for the next generation to tackle. It is something that our generation has to actually tackle. And if you see on the bottom right, countries with highest carbon footprint, this is just on an absolute basis, not per capita. India currently ranks third after China and the US. Um, Effects of climate change, as I've mentioned earlier with some examples, are becoming more and more severe. So what you see in this world map is the areas in like pitch black are basically too hot for human habitation today, and the ones which are shaded will be too hot for human habitation in about 50 years time, less than 50 years time. So if you zoom in on India here, majority of the country, the Indian subcontinent rather, will become too hot to live, essentially, right? So hence the problem of migration, the problem of crop productivity, and all this in a phase where the population is still growing and thriving. And there are a few other statistics that I'll just let you read here in terms of impact on labor productivity, crop yields, and etc. Moving on, what's already happening, what we see. The chart on the left-hand side is essentially economic losses from natural catastrophes over the last, I think, 40, 50 years now. What you clearly see is both frequency and magnitude of economic losses is rising. The typical once in 100-year flood is actually now happening once in every 5 to 10 years, right? So it's ideally supposed to happen once only in a century, but that's not really what's happening. If you look at it from a numbers perspective, India suffered economic losses of about almost 12 billion US dollars during 2023. And this is well above the past 10-year average of about $8 billion. So these statistics are re-emphasizing the fact that both the weather is getting much more erratic because of climate change and global warming, and hence as investors we have to pay attention to the carbon emissions and the amount of pollution broadly that companies in our portfolio are doing, and actually push them towards decarbonizing. That's where the world is heading. The chart on the right, the India map, which is pretty much all red, shows about the areas in the country which will have water stress by 2030. Now this is more near term. We're talking about pretty much 5 years from now. And as you can clearly see, most of the country is either in high and extremely high water stress zone. This is again data from World Resources Institute, and it clearly says water as a resource is something that we need to pay more attention to. So I'm just trying to give you a few more examples as to why investors should pay attention. Now, coming in from a policy kind of tailwind perspective, what is very clear, as you see on both the charts, is countries across the globe have said we want to decarbonize, meaning we want to make our day-to-day lives, our economies more carbon efficient, meaning emitting less amount of carbon emissions per unit of GDP growth. So very clearly in the last 4 to 5 years, you've seen almost basically all 80-90% of the emissions of the world, saying we will do net zero. Now, some countries have said 2050, some countries have said like India 2070, but basically everybody is clearly saying we are going to reduce emissions in our economies and eventually limit global warming. If you look at specific to India, and maybe I'll go to the next slide, the same points are here. In India, India's 2070 net zero commitment is essentially expected to drive about 150 to 200 billion dollars in capex per year. Right, this is not cumulative. This is per year until 2070. So if we are supposed to meet all of our climate goals, then this is the amount of investment that will be happening every year. Um, Taking example of renewable energy generation, the 2030 goal for government of India is to meet half of our energy requirements from non-fossil fuel based energy, meaning non-coal, non-oil and gas. And this will be predominantly from renewable sources. So clearly what you're seeing is the energy mix, what on the left, which is 2019, about 20% of our energy was renewable, where it will clearly move quite high. So 50% by 2030 and almost 70% by 2050. So very clearly you're seeing there will be growth and let's say secular growth in renewable energy generation, and not just the power producers, but also the equipment suppliers, right? So if every year, what you see on the chart on the bottom right, you need 20, 25, 30 gigawatt of solar, utility scale solar implementation, then obviously companies which are manufacturing these equipments, companies which are providing transmission and distribution infrastructure, all of these will actually benefit. So this is kind of the opportunity angle of climate risk. What we saw in the earlier side was the risk part of it, but clearly there are, I'd say, trends that are becoming more and more bigger for investors to ignore, and hence I think we should be paying attention to this. So that's kind of, we went through the definitions of what, the why, and now we're coming to, okay, how can we go about integrating sustainability into investment decisions? So on the next couple of slides, I'm going to talk about a little bit more at how we at DSP kind of approach this. And then I'll go into a case study where we'll say, okay, if you're looking at a particular company, how would uh, a particular E or S risk change your opinion as an analyst? So let's start with what we are doing, or what is our approach at DSP. So our responsible investment approach is essentially based on two pillars. First is ESG integration, meaning we would want to kind of pay attention to material, environmental, social, and governance factors while we are doing investment analysis, while we are doing portfolio construction, and not kind of look at it as an afterthought. And active ownership, predominantly corporate engagement, is another area which is very important, because a lot of the companies in India, and I think broadly in emerging markets, are still in need for a little bit more education, awareness creation around why this matters, why you should be paying attention to this, why is it not just good for the world, but it's actually good for your business as well, and long-term sustainability of your business. And hence engagement with companies in your portfolio is a key aspect of our approach towards ESG, because this is it's important for companies to kind of understand why investors are asking these questions, and why it could help their business kind of be more sustainable in the long run, and then they will start implementing kind of these practices. In terms of initiatives that are kind of something that we support, I think Climate Action 100 Plus is one that I would want to call out, which is, this is an initiative, global initiative, basically engage with the top 150 carbon emitting companies in the world, right? So you're talking about the big oil and gas players, big steel, cement players, and so on. And obviously some of these companies are Indian. So we do participate in some of these engagements and encourage decarbonization as a strategic approach rather than ad hoc. And that has definitely helped a lot of companies move in that direction. So obviously helps us as a country and as a asset manager as well. What is the process like, right? So typically what happens is we have an ESG opinion or an ESG analysis on companies, most companies in the portfolio, wherein we will look at, let's say if you're of a utility company, how are you kind of generating power? What kind of fuel are you using? If it's fossil fuel, how do you make sure the processes are bit more efficient? If you don't have renewable energy exposure, how are you going to kind of let's say switch your fuel mix, switch your energy mix, and so on and so forth? So this is one example. We look at social issues like human capital, health and safety, data privacy for, let's say, tech companies, for example, or banks even. And then on the governance side, it's largely corporate governance, things like related party transactions, board independence, auditor independence, and so on and so forth. So it's a pretty comprehensive framework. We've created a proprietary framework, which is having about 45 scored criteria across E, S, and G pillars. And then we create a kind of a custom score for companies in our coverage. That will then help the sector analyst and eventually the portfolio manager understand where the companies are doing well, where there is maybe a gap that needs to be addressed. And sometimes that gap is what drives our engagement efforts as well. So let's say if we find a company is actually, instead of reducing their carbon emissions over time, actually increasing it, then that's a good point to maybe raise in the next management meeting that we have and say, okay, what's going on, what is your strategy to decarbonize, and so on, right? So that drives our engagement and eventually engage outcome of engagement. So the company responds. Sometimes they might say, yes, we acknowledge and here are reasons why this is happening. Other times they might say, we didn't kind of pay so much attention to this, but going forward we would. And hence maybe in 6 months or a year or 2 years time, you might want to kind of circle back and say, okay, what's going on? Last time we spoke, you said you will do this and that. How has it progressed? So it gives us feedback as well. Typically in management meetings, you would talk about revenue growth, margins, and so on. In addition to that, we also bring in certain material E&S topics, so it helps us get a more comprehensive view of the company. We also do engagement, like I said, and this is just a framework for how we approach, say, overall engagement, right? So again, it has to be a mix of what I would call as education and like maybe information requests to also educating them and saying, okay, this is why we think it's important for your sector and your business. And hence we as investors want to kind of see more progress on A, B, or C topics, right? So it's not every single time if a company is not doing well, you would straight away say, oh, I can't invest in that. There are, I would say, some topics or some cases where the threshold level or the tolerance level is low. In other cases, you might give companies a little bit time to act. And if over time, let's say over a couple of years, you're not seeing progress, then you might think of escalating, and kind of this could be via proxy voting. This could be via maybe talking to senior management or board and figuring out what's going on and then taking an informed decision. So there are different ways you could do this, but this is broadly, like I said earlier, integration and engagement are the two key pillars in our approach to do ESG. Now, we've talked multiple times about materiality assessment. So some of you might be thinking, how exactly do I do that, right? How do I find whether a particular topic is material for a particular sector or not? Here I've tried to give an example of how do you assess the materiality of a particular topic. So here, the example talks about labor rights, right? So labor rights, labor practices. Now, for you to, as an analyst, to kind of figure out whether it's material or not, you look at various things, right? So are there current or upcoming regulations on this topic, right? So compliance with regulations, in case there are either the company you are evaluating or peers, if they are mismanaged or not kind of aligned with that particular regulation, what have been the level of fines or penalties? Is it impacting, if they're mismanaging this, is it going to impact the top line, bottom line? Is it just purely going to be reputational in nature? And then the question is, what is the probability of impact? Now, today, if we talk to most people, uh, they will say, yes, climate change is important, climate risk is going to play out. But whether it's going to play out in 3 years, 10 years, 30 years, the answer is different for different sectors, different countries, and to some extent, different geographies as well. And hence, you need to assign to what level of probability you think this is going to play out, because that will give you overall, okay, should I give it a high weight in my analysis or low weight in my analysis? And what you see, some kind of snippets from media are examples where mismanagement of labor practices as an issue have impacted companies financially. And I'll let you kind of read through those at your own convenience. One last thing in our framework, which is also important, is forensic analysis. And I'll not go too deep into this, but the idea is to look at kind of companies which are having either like aggressive accounting practices, poor earnings quality, sometimes manipulated cash flows that are not kind of believable in some form. So avoid these kind of pitfalls, avoid this kind of in some ways landmines. And this is something that we are doing. I think we are one of the unique ones in the market where we have a dedicated forensic analyst who looks at companies in our coverage from a forensic lens and flags companies which he thinks are basically doing one or more of these, let's say, uh, aggressive accounting or broadly poor kind of reporting and governance practices. And that is something that then either we feel it's just too bad to invest, and then that could kind of go into our exclusion list, or at times we would just engage with the management to get more clarity. This slide gives you more detail about our framework, and I think after the webinar you will get access to the slide deck, so I'll let you kind of go through it at your convenience. So this is again an additional kind of check. I would say broadly on the G side, but like what we call it as is forensic analysis essentially. So looking at quality of accounting as well as management for a company. So that's kind of been our approach. Now we getting into the last section of my talk and prepared remarks. So there's a small case study. So I'll spend maybe about 4 or 5 minutes on that, and then we conclude. So here I think we're saying, let's imagine there's a large Indian steel manufacturer. 90% of companies' assets are located in regions where there are either currently carbon emissions, or there could be carbon emissions coming in, the carbon emission regulation rather coming in the near future, right? So this is something that is the broad background for a sample company. If you as an analyst are looking at it, how would you assess carbon risk or climate risk broadly for this company? So you look at regulations, right? Currently, as many of you might know, India has already announced a carbon credit trading scheme that will most likely go into force this year. And for this case study, I'm just assuming a 500 rupees per ton of carbon price, right? That is the carbon price I'm assuming. What it comes out in reality could be market driven, so could be lower, could be higher, but just for sake of this illustration, I'm assuming a 500 rupees carbon tax. So here's a company where they are doing some initiatives to reduce carbon emissions, but nothing significant. Steel as a sector is very carbon intensive. So in that context, if the company is expected to pay 500 rupees per ton of carbon emissions, how is that going to impact its margins, its profitability in general? So what you see on this slide on the left-hand side, before we kind of factored in this carbon risk or ESG risk, the analyst kind of base case, meaning what is most likely to happen as per him or her, expected IRR was about 12%, which is quite decent, not bad, right? You would consider investing in a name like this. In the bear case, it was going minus 20 for various reasons, and in the bull case, obviously 25%. So that was before you factored in the climate risk. Now that you say, okay, the company might have to pay carbon tax, what will happen, right? There will be two or three things that will happen. Obviously, the most obvious one is there is a pressure on its margin because you have an increased cost, which is the cost of carbon credits that they will have to buy, or carbon kind of allowances. Because of the increased regulation, they might be allowed to produce less than before, because if they keep producing more steel, that means they're going to have more carbon emissions. So there could be an impact on revenue growth. There is an impact on margins. And hence, because of that, you would see on the base case on the right hand side, basically, if the company is less profitable, or not profitable, you don't expect them to give dividends, right? So cumulatively, you see very clearly, excuse me, both impact on the top line, which is revenues, lower revenue growth, but also on the margins, eventually leading to the expected IRR after integrating this carbon tax to a negative number. So if you as an analyst had not paid attention to this environmental or material environmental issue, you would have said this company looks great, let's buy. But after factoring in, it doesn't look as great, right? So very clearly, this is an example to kind of show you that the company, I mean, say ignoring material E or S risk could actually make you vulnerable to these kind of say unknowns, right, in some form. So hence it makes sense. Like sometimes you might say, so I've taken a 500 rupees. If you take 200, maybe the numbers look slightly better. So it's up to you as an analyst to kind of do your projections or do your estimation, and that's always the case with financial analysis. But just the fact that even with a small 500 rupees per ton of carbon tax or carbon kind of cost, um, companies straight away getting kind of less attractive, right? The valuation is probably not as high as it should be. So these are like the reasons for which you pay attention to these kind of things. Now, if you take a similar case, let's say for a tech company, the margins are usually higher, so and they have usually more cash pools at hand, and B, as a sector as well, the carbon emissions are not as high as steel. So the impact on a tech company might be a little bit muted, or they might be able to absorb the carbon tax versus some other company in this sector, for example, which is not able to absorb or pass through this cost, right? So depending on the sector, the impact might be low, medium, high. But the fact that this could materially change your investment decision, like in this example, it makes sense to pay attention. And that's the point I want to make. Um, getting into, I'm just curious of the time. Yeah, I'll probably take a couple of more minutes and then we can go into the Q&A. So please feel free to send your questions if you haven't yet. What are the key takeaways, right? I'm just kind of re-emphasizing stuff that we've discussed. There's no right or wrong way to do ESG. Depends on investors' motivation and goals, depends on what kind of asset class and what kind of geography you're investing in. It's very important to be clear as to, if you're a fund manager, what you are doing and what you are not doing, so that the investor doesn't feel that, oh, I'm subscribing to this ESG fund because it's no tobacco, but actually you have tobacco companies in your portfolio. That is totally fine as an approach, but if you're not very clear and transparent about that, then there will be allegations of mis-selling or in some form greenwashing. Because of increasing materiality of environmental, social, and governance issues, both in developed but also emerging markets, you are seeing these risks becoming more and more material, and hence investors paying more and more attention. I mean, what happened in the last couple of weeks in California is again a clear example of material kind of climate risk exacerbating, or let's say increasing the weather and wildfire risk, right? So it's not only impacting real estate as a sector, because let's say if you are want to live in LA, and if the area where you are looking at kind of buying a huge, let's say, multi-million dollar mansion, if that is prone to wildfires, right, that would you want to kind of invest there? Probably not. And then even if you already have a house there, would you get sufficient fire insurance or wildfire insurance? Today, the answer is no. It's just because the frequency and magnitude of these events are so high, insurance companies are not willing to take that risk of fully insuring rather properties there. So it's basically both impacting, let's say, for an insurance company, new business potential, but also the claims are higher because of these kind of activities happening pretty much every other year. We already looked at the carbon emissions on the steel sector example in India. Last point I wanted to make here was there is a very clear kind of switch. So when you see it about evolution of ESG, and then in the India market is fairly more recent, but globally this has been around for at least 10 to 15 years now. Initially, people were like, I want to have a broad ESG score made out of 30, 40, 50 factors, like this framework that I talked about. And I want to have like a weighted average high score. That's what my goal should be. Very clearly, what now the trend is changing from broad ESG to specific themes and KPIs. It could be low carbon, it could be affordable housing, it could be diversity. Depending on the investor preference, there might be different KPIs or metrics that they use. But very clearly, what I'm seeing is investor preference going from, I just want a portfolio who has a weighted average overall good ESG rating, to I want a portfolio that has low carbon. I want a portfolio that is free of modern slavery, for example, and so on and so forth. So that is something to keep in mind as you evaluate both creating new products but also investing in them. How can you get involved, right? How can investors kind of structure their ESG efforts? I think the key point I want to make here is ESG should be integrated in your investment process and not as an afterthought. So it should not be that the analyst and the portfolio manager is doing what they are doing, and at the end of the whole process, you just say, okay, let's screen out a few names and that's it. That's all we will do. It has to be kind of materiality assessment, integration, engagement, like we saw in the case study. It has to be part of your financial modeling, not something that is an afterthought. There is obviously a need to build more capacity. So it's not enough to have ESG specialists, 1 or 2 or 4 in your team. You need to train mainstream equity and bond analysts and portfolio managers on this, because eventually they are the ones who are going to call the shots. So it makes sense for them to both have a good understanding of how do you translate ESG risks to financial risks, and then basically start getting a knack of estimating them in the right manner. And obviously, there are a ton of certifications, including from CFA Institute, which are available to kind of get your basic ESG trainings. And then lastly, ESG oversight is quite critical in my opinion, meaning they should be supported by the top management. So if your CXC suite is not on board, you can't really expect to kind of do this more structurally and systematically. So that is something again which is very important. I'll just pause here and hand it over back to Pankaj for Q&A.
Thank you so much, Hardik. I think it was great as we have more and more comments in, and it was very insightful and very detailed, and also the illustration and the example were perfectly good in terms of how we communicate the ESG story into investment. So thank you so much for sharing your insights, Hardik. Now let's start with the Q&A, and it's a very interesting question coming from Siddhi Lodha. She's asking, like, depending on how many investors you probably look at, there is scope that probably more investor can adopt it, or probably more investor can look at it. How do we do that? How do we make more investors to consider ESG over long term and in their investment decision more frequently?
Yeah, so I think you need to understand the investor's motivation, right? So I think through this presentation, I think I've been repeating the word materiality, right? So if the motivation is just managing risks, right, and that is obviously the right motivation as well, then you, like I illustrated through this presentation, you need to tell the investor why some ESG risks, not all of them, but they are playing out now, right? So if you don't pay attention, you could basically end up buying a company whose assets are basically impacted by, let's say, wildfires, or who's going to face a huge carbon tax bill because they are not managed their carbon emissions well, and hence it's going to affect profitability. So you need to make that linkage from environmental, social to financial materiality. That's the easiest way to convince someone that, okay, my goal to do this to ESG integration is not to save the world, right? It is definitely one thing, but my goal is to basically identify, quantify material risks and factor those in, so we are not kind of left surprised or shocked by some event happening and then suddenly we don't have basically an out, right? So I think that is something, that is one way to kind of approach this. There are certain group of investors even in India who are motivated by values, right? Sometimes they say, I don't want to my investments to be associated with certain things, and then the screening part is something that you can pitch to them. But I think the materiality angle is kind of almost like a no-brainer. So if you can build that case, then nobody will say, no, still I want to ignore these things.
Thank you, Hardik. There's a question from Akashdeep Grover. He had the opportunity to work with several tech companies in the US, and I would say that probably it's not just tech companies, but it apply to everyone, that the sustainability often comes at a cost. And that's what he's asking. Do you believe that Indian business ecosystem is prepared to embrace ESG principles despite the financial implications and cost in some cases?
Yeah, I think that's a good question. And this is, I wouldn't say it's entirely a myth. Yes, sometimes you will have like a cost implication for being more sustainable. But if you're looking at the long term, which is what most companies should, right? It's not about the next 2 quarters that we are worried about. You want to be a going concern in 10, 20, 30 years time, and obviously growing your footprint as a company on growth, etc. Right? So if you look at it from a long-term perspective, I'll give you an example of, let's say, how you do capital expenditure, right? So when you are, let's say, putting up a new plant, there will be upfront costs that you will do, and then over a period of its life, the plant, the factory or the power plant, whatever it is going to generate revenue and give it back to you. So think of this more from that perspective. This is a short-term cost, but in the long run, what will happen is, at times it could make your business more resilient to certain risks, right? And hence basically avoid bigger costs in the future. B, it could make your company's, let's say, brand more positive in terms of the consumers' minds. And hence you might see more demand for your products and services. So let's say if today if I'm an environmentally conscious consumer, I might buy a product which is made out of recycled, let's say, wood versus otherwise, right? So those kind of things. So it is think of this more as a investment with a medium-term payback rather than a cost. That's what I would kind of advise.
I think that's a great way to look at it, because ultimately the costs associated need to also get balanced with what are the upsides and downsides. I think that's a good way to look at it. Thank you, Hardik. Let's move on. Pooja Jain, she is asking that how do we arrive at the risk adjustment factor? And when you look at a lot of these things like displacement, low productivity, and when you look at sectors or companies, how do we adjust the risk which we have because of these factors, and how do we calculate that? Like,
Yeah, so I wouldn't say it's a straightforward science. I think doing this is an art and a science, and that's why I think uh, asset managers who are able to do this well will obviously be in demand, right? Because it's not like a quantitative easy thing that you can get online. The way I would look at it, so let's take one of the things that she's mentioned, Pooja. Let's look at low productivity, right? So if you are an investor in agri commodities or maybe real estate development kind of sector, because of low productivity, what is going to happen in agriculture? Basically, your yields will go down. So how much output of a particular crop you are expecting to produce, that might be lower because simply people don't have uh, time or cannot physically stay out in the open long enough to kind of, let's say, sow more seeds. In the real estate sector, your gestation period to build a particular building, whether it's a factory, industrial, office, whatever, is going to be longer. Because if you can only work, and this is already happening for a number of years in the Middle East, for example, when you go there, let's say Dubai, Abu Dhabi, you see a lot of the construction work actually happens in the night. Because in the daytime, it's just so simply hot. You're talking about 50 degrees Celsius kind of situation where people simply cannot like do say physically intense work outside. So if that is the case, either you shift your business model or you work for less hours in a day. And again, that will mean higher costs, higher lead times, and so on and so forth. So that's how this could translate into basically company impact. And that's how I would kind of encourage you to think about it. Now, the question is whether it will mean 2 months more to build a building or 20 months. That is something that you as an analyst, that's your skill set, right? What kind of assumptions you take. And you don't need to be perfect, or you can say, like I showed you, in the base case, I think it will take 3 months more. But if it's worst case scenario, it might take 10 months more. And then what does that mean from cost perspective and eventually basically the return perspective for the project? So that's how you would go about it.
I think that's a great example which you talked about, real estate company. I think it used to happen in India that the first quarter of the financial year, which is April to June, used to have a significant impact because of weather conditions in north and west on construction EPC companies. Similarly, like the second quarter used to be there'd be an impact on company like Coal India Limited, because mines will not be operational for that long. So I think that that's a very valid point, and this is how sector by sector, company by company, we need to look at. Thanks, Hardik. Next question is Chandrasekhar Mangipudi. His question is that how do we integrate ESG into valuation? So let's say, what is that we need to do to ensure that the current valuations don't factor in, or whether how much of this has been factored in as far as ESG factors are concerned?
Well, so I think the example I showed, the reason I separated out is just to show the impact of the climate risk or carbon risk in that case. Ideally, your model should factor this in like while you're building it. There should not be a pre and a post kind of a thing. Uh, and I think some of this is already happening. It's just that analysts may not be tagging that kind of activity as ESG incorporation. So, for example, if you look at, like you gave the example of coal, right? So say if there's going to be less coal mining because of weather extremity in a particular quarter, you will build in less growth and less output for that particular quarter. So that's essentially what you're doing. There are at times health and safety incidents happening, right? So because of maybe gas leaks or some sort of a blast in a factory, production stops for a few days. So then you as an analyst would say, okay, there's going to be 20 days of less production in this year or in this quarter. What does that mean for top line impact? How much inventory do they have? Is there enough to kind of fill the gap? Otherwise, they'll have lower sales and so on and so forth. So I think that's how you go about it. It should not be like here's my financial model. Now, how can I add ESG onto it? I think over time, it's not going to happen on day one, to be honest. I think you kind of learn how to interpret certain things, and over time, I think analysts are a smart breed, so you would expect them to pick these things up over time.
Thank you, Hardik. Next is from Rahul Rajput, and he says that he has been tracking the climate change goals and how we have achieved and accomplished them. And the fact and conclusion is that we are far behind, where we look at net zero by 2030 or whatever. And he says that what is that like? When should we have the feedback cycle which will trigger, and then we have real impact? So, of course, whatever we have committed, we have not been able to achieve that target. At the same time, we need to have some mechanism so that there's a feedback cycle and there is a penalty or reward for the behavior which we are achieving and which we are doing.
Yeah. So I think I would not disagree that like we are the world as I mean, it's not just India. I think the world collectively is not moving in at the right pace, in the right direction. To be honest, I think that we have mostly shifted the direction, or at least made our minds to shift the direction of carbon emissions, but it's not at the right pace at the moment. So things are, you don't, I think, see, the way I would think about this is, you don't like it, you must have heard of the story about the frog in the boiling water, right? So once it's a little warm, it's comfortable, he's enjoying it, and then it's just too hot and too late to get out, essentially, right? So you don't want us to get into that situation, so you don't have to wait for, or now I'm 100% sure physical climate risks are going crazy, and hence I will now start factoring in ESG. I think it will be too late to do that. Most analysts will look at historical trends and try to extrapolate. The chart that I showed earlier around environmental driven catastrophes, right? That is a one indicator. You look at carbon emissions and the temperature rise. So I think 2024, if I remember well, I think 9 or 10 out of the 12 months in 2024 actually had record temperatures versus history, right? So every year that number is going high. Maybe 10 years back, only 1 or 2 months in a year had like extreme temperatures. Everything else was within the normal boundaries. So you're clearly seeing things moving in that direction. At some point, this will create, let's say, a vicious cycle, which I hope we don't get there, because it's not just dollars and rupees that we are trying to save. Climate risk is basically an existential risk, right? It's about existing as humans, and a lot of times we forget that we're not trying to save the planet Earth. Planet Earth was always there and will remain even much after humanity, let's say, ceases to exist. We're trying to save us as a species, right? So that is something that needs to get into our heads, that it's not just about dollars and rupees, especially when you talk about climate change. So I think it's just that we need to believe on scientists projections. They've been tracking carbon emissions in the atmosphere for decades now, and you clearly see a linkage between human-driven fossil fuel emissions and carbon emissions and global warming. So there is no denying that this is the cause of the acceleration. Now, how bad can it get before we get more impacted? Nobody can guess that. I think hopefully we don't get to that state.
Very well said. I think Earth has been around for almost 4.5, 5 billion years, and it's just humanity which has come very recently. And we are not saving Earth; we are saving ourselves if we at all do something about it. Thank you, Hardik. I think